Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Today, I'm going to look at a half a dozen regional banks, each of them being a dividend champion. And what that means is each of the banks I'm going to be covering in this video have increased their dividends by at least 25 years or longer. And so if you're looking for income, and most of these have above average yields, all of them have almost double the yield of the S&P 500. But some of them have even some very attractive yields. Only one of them is below 3%. So these are very interesting companies. They're also all trading at fair values. Now, I had an interesting experience in my last video. One of the commenters said to me, "Chuck, stop bottom fishing." And it just absolutely brought just a chuckle to me. In other words, you're asking, AKA Mr. Valuation, the value investor, to stop bottom fishing. So I guess what you want me to do is start trying to show companies that are overpriced and have already gone up significantly in value. You don't want me to show stocks that are trading at a bargain, that are trading for less than their intrinsic value, so that you can reduce your risk and dramatically increase your rate of return. Bottom fishing is what value investing is all about. All 6 of these companies are trading at attractive valuations by most metrics as you would measure them. And they all have this long history of increasing dividends. So let's go ahead and get into FastGraphs and let's start looking at some of these. The 6 names I'm going to cover is AROW Financial Group, Community Financial System, Community Trust Bankshores, Citizens Financial Services, Bank of the Ozark, and First Source. Now, there are several other Dividend Champion regional banks that are in the Dividend Champions list. And a lot of regional banks are very attractively valued. And we'll kind of examine that as we go through the individual graphs of each of them. But I want to make a point here. If you're investing for income, investors invest for different strategies. That's another thing. A lot of people automatically see videos like mine, and they think I'm predicting a stock that's going to go up in the next week. Well, one of the most important things you can do as an investor is recognize what your holding period is going to be. Now, I believe in long-term investing, and I believe in investing in a business that I find very attractive, that I can also buy below its intrinsic value, so I'm buying it at a bargain price, but also so I can get, for example, if I'm investing for income, an increasing income stream. And what makes a dividend champion interesting is every year they raise their dividend consecutively for at least 2.5 decades. That's what qualifies them to be a dividend champion. That kind of consistency is worth looking at. So we're going to look at several of these. Let's start with AROW Financial, and I'll continue to interject some of this investment philosophy of value investing, if you will. So looking at AROW Financial Services, first thing is the company is a bank holding company which engages in the position of banking and insurance through its subsidiaries. It's headquartered in Glen Falls, New York. Okay, so this is a New York bank. Now, if I look at the historical graph here, a couple of things. Notice all these little splits here. They've just had these small little splits or spin-offs, but we're not going to worry about that. What I want to talk about is the lines on a fast graph, because I think people really don't understand it. So let me reiterate what I said a minute ago. As an investor, you imply a long-term holding period. You're not buying the stock today so that you can sell it next week or tomorrow. You're trying to find a company that you can position your capital in and leave your capital there for years. Now, I always say a minimum holding period is 3 to 5 years. Warren Buffett said the best holding period is permanently or forever, because that's the idea. If we can find a business when it's attractively valued, and when you're looking at a fast graph, for those that don't know, the orange line on the fast graph represents the intrinsic value of the business. So if the price is above this orange line, which is the black line on the graph, if the price is above the orange line, the stock is overvalued at that time, and if you bought it, you'd be paying more than the business is worth. If the price is below the orange line, like you see in many cases here with AROW Financial, and like it is today, then you're buying a stock for less than its intrinsic value, which means you've got natural leverage. You've got the ability to see growth from the company, also dividends and dividend growth from the company, because after all, this is a dividend champion that's always raising its dividend. And you've got to participate in the growth, the income, and the PE ratio expansion. And that's leverage, and that's how you can make a great deal of money investing in these companies. Now, regional banks are considered generally very safe investments. Another way is you want to value a regional bank based on its price to book value. Okay, so now we had some questions on a video that my son Colton did. If you go in here, when you go into fund graphs, which I just went into, and you look at custom charts, okay, I've created the price to book charts. Okay, if you don't have that, it's because you haven't created it in your own subscription. These are my custom chart that I've created, but I simply go here, and what I look for is I can add metrics here, and or I can create a new chart by this button up here. Okay, and then if I want to add metrics to this, if I want to add metrics to the price to book, I click here and be able to add metrics to it. All right, but that by clicking on these various metrics here. But this is just simply a price to book value. Now, what I want you to note here is this company is often traded at a price to book of 1.5 or higher, or 1.4 to 1.5. It's currently trading at a price to book of 1.07. So that would be what I would consider an attractive price to book value. But looking at the company from an operating earnings point of view, we can also see that the earnings have been very consistent. We did have a drop-off in 2022 and 23, but now the earnings have been recovering and are expected to continue to recover. Looking forward, the stock is expected to grow at over 19% a year. So if this stock traded at a PE ratio equal to its growth rate of 19, your upside on this stock could be as high as a 76%, 77% annualized rate of return over the next, let's say, 2 years, a year and a half or so. Okay, if we use the normal multiple for this company, which has been closer to 13, a very low multiple rather than 19, you'd still stand to make over 35% on your investment. And what that means is you would get the 19% growth, you would get the PE ratio expanding from its current 11.28 up to a 12 point, or we'll call it a 13 PE. So you get slight PE ratio expansion, plus you get a dividend yield of 4.38% that is expected to increase every year. And here we're only looking at 1.5 years out. Okay, the company has a good scorecard, not a great one. They have missed estimates from time to time. Another thing people talk about, saying you got to really know the business. Well, the bottom line is with fast graphs, go through this eternal links. If I subscribe to several research, you can go into places like Seeking Alpha, for example, and you can evaluate research. I think the best place to go with these companies is to go right into the company's own corporate website and look for their shareholders and investor services and investor frequently asked questions. Look for news and highlights. Look for corporate, what the company does. Look for investor services. Most of these companies will have an investor services division, and that's how you can learn more about the company. But you can also go into sites like, for me, I can go into Morningstar as a subscriber, and I can look at what Morningstar is saying about the company. And here I'd have to sign in, but I'm not going to do it just to save you. But I could go in and look at what Morningstar has to say. I could also look at Zacks, Seeking Alpha. I can go into Yahoo Finance and several other sources. I do want to learn about the company, but the analysts have already done all that heavy lifting. So before I do all of that work, I want to see, does it even make sense for me to look at the company? Now, AROW Financial has an extremely attractive forecast growth rate. Okay, but there's not a lot of analysts following this company, okay, because it is a small cap company, so you're really looking at one man's opinion here. Now, what you can do is looking at the earnings estimates. You can go into Yahoo Finance, for example, and look and see what their estimates are. But the key is, if there's a 19% growth rate, then I'm going to dig deeper and try to find out why, okay? The next company we're going to look at here is Community Financial Systems, CBU. Now, I did a report on this company. In fact, if you go into Yahoo Estimates and just get a quote on the company, you can see it's up 0.5% today. If you go in here, you can see the report I did on Yahoo Financial, where I talked about this particular stock in quite detail. You can just click on this and get the whole report, including the fast graphs that I included in that report. So, but again, I want to make something very clear as I'm looking at these. I want you to use your common sense. What is the most unpredictable line on this graph? That would be the black line. That's the weekly closing stock prices. People are always judging whether an investment is good or bad, whether it went down or up a week or a day or a month after they bought it, or even after I did a video on it. You got to look 3 to 5 years down the road before you can really start judging whether your investment is good. And by the way, you haven't lost money unless you sold the stock. Now, if you bought the stock and it went down and you sold it, you lost money. But if you could have bought this stock here, for example, on February of 2009, paid a price of $17.64, and by July of 2009, the stock price would have been down, and you'd have been to $14 a share, down 3% or $3, and you'd be down about 18% or 24% without the dividend on your investment. But if you continued to hold the stock for the appropriate holding period, even today after it's undervalued again, you'd be averaging over 8.5%. And if you were an income investor, you would get a raise in pay every year. You would get an increasing dividend. The dividend has constantly and continuously gone up each and every year. And that brings me to another point. The second most predictable line on the graph would be the orange line. But the orange line is a little bit volatile itself. This company has good years and bad years and flat years, but it's always profitable. I do want you to notice that. Okay, and the most predictable line on the graph, of course, is the gold line. This is why it's a dividend champion. Every year they increase their income. So if you bought this stock, all right, let's go back here before I do it. Let's look at the historical graph, and let's put closing prices on the graph. And you could have bought the stock here at a reasonable valuation, slightly below the orange line, okay, and held it for this time frame. So if I look at the performance graph now, what I see is I'd have started out with about a 2.6% initial yield. If I'd invested in, this is based on a $10,000 investment, just as a metaphor. If I'd have bought the stock on December of 2024 and held it through yesterday's close, August of 2025, okay, I'd have started out with a 2.6% yield. And by the way, I would have bought just the same amount of shares. My shares would not have changed. The dividend is paid on the number of shares you own. Okay, so whether the price goes up or down doesn't matter. I'm getting a dividend that basically is based on buying 354 shares, 353.98 shares of the stock. So my income started out at $261 on $10,000. Then it went to $276, and if you just follow me along, pretty soon it's paying over $400. And last year it's paying well over $644. And so that's my yield on cost. I call that growth yield. In other words, but the point I want you to get is the income is increasing every year. So you're an income investor, this is an investment that would be suitable for you. Okay, now the price is going to go up and down, up and down, up and down. Notice that the price tends to follow the orange line. And when it gets below the orange line, it tends to come back. I don't know why people can't understand that and why they can't trust that. When the price gets, here it took a very long period of time, but actually during COVID, it got back to fair value. Then it rose again. Then it got undervalued, and then it got overvalued again. But the point is, if you trust the orange line more than the black line, you'll do well. And if you're an income investor, this increasing dividend income each year is really attractive. This company has very moderate debt, and it's a high-quality regional bank. Now, if I go into fund graphs, like I did before, and I'm going to show you how I do it. I go into my metrics here, and I go into my custom charts, and I bring up the price to book, which I built myself. Okay, you would see that the price to book at the end of last year was just over 1.6, and this is one of the lowest prices to book that it's had. So its company's trading at a very attractive price to book. Now, moving on to Community Trust Bank shares, it's trading at a little higher price to book, relatively speaking. But if I look at this company from a standpoint of fair value, it's only trading at a 10 PE with a 9% earnings yield. If I look at it from the standpoint of operating cash flow to see how well the dividend is being covered, I see that the company is well covering the dividend. I don't care about the price here. The orange line is way higher than the gold line. The gold line is the dividend. The orange line is the cash flow they have to be able to pay that dividend. And ultimately, I'm looking for stocks that have operating cash flow or free cash flow, which is the real asset test, that is higher than the dividend. They got plenty of cash to pay the dividend, and they got very modest debt. They got a very high earnings yield, and you can buy this stock with a current yield of 4% had you bought it today. The next stock here is Citizen Financial Services. I'm going to look at this stock from a standpoint of diluted earnings here, because once again, I want to make the point, the most consistent line on the graph is the gold line. That's where they've increased their dividend every year for 25 years. The orange line here in this case, which is diluted earnings, is a little bit erratic. The most unpredictable line, the line that you can't really predict, and the most scary line would be the price line. And you can see why prices and price lines are scary for most people. But again, it's a good stock. Bank of the Ozark here, let's look at it from a standpoint of adjusted operating earnings. If I look at it, you can see that the stock is very cheap. Now, this company's gone sideways for 4 or 5 years. This is where, like, if you bought it back here and you held it to here, you'd be averaging about 8.67%. But what I want you to understand is, by buying it back there, every year during that time frame, your income has increased. That's what an income investor is looking for. They're looking for a long-term investment that they can invest in where the dividend is going to continuously increase. And this company has a very attractive payout ratio, by the way, which means they have plenty of room to pay the dividends. Now, I can also look at it from a standpoint of operating cash flow, and I'll go through this process. I'm also going to look at it from a standpoint of fund graphs. And again, I'm going to show you this again. I'm going to go into my metric bar up here. I'm going to go to my custom charts, and I'm going to look at the price to book value chart I created, and I've got a very attractive price to book value on this company. And if I go looking here at First Source, I see another one that has a pretty decent price to book value. If I look at the historical graph, it's trading well below its adjusted operating earnings. Let me add that on here. It's trading well above its adjusted operating earnings. And once again, it's trading at such a cheap valuation that if it traded at a normal PE of 15, you could stand to make over 40% a year. These banks are cheap. Now, historically, there have been many times, as you can see just by looking at this graph, where the stock is traded above the orange line, many times where it's traded below the orange line. But as long as you're buying it at value, even when it stays undervalued, you can still make a double-digit rate of return. The company's forecast growth in this case is expected only to be about 4.5%. But if it traded at a 15 PE, that simply means you can make 40% a year. The normal PE more recently has been a lot lower, about 11 times earnings, but you'd still be able to make a double-digit rate of return of over 17% a year. Now, this one is the lowest yielding one with only a 2.5% dividend yield, but that dividend yield is more than twice what the S&P 500, which is what this graph is all about, is paying. So this would still be considered an attractively yielding investment. Catch myself back up to where I was. The Bank of the Ozarks is another one, very inexpensive, with a yield of 3.55%, an earnings yield of over 13%, very low debt, and once again, look at the gold line. These are long-term investments. It doesn't matter if the price wiggles a little bit in the next week or month or 2 months. What you got to do is recognize and understand that the markets often misappraise stocks. And when they do, you want to take advantage of that. When the market prices the stock well above the orange line, if you're a shareholder, that's a good time to sell. Look what it would have accomplished had you done that somewhere close to the top. You'd have saved yourself all that grief. On the other hand, you buy the stock when it's inexpensive, even if it goes down a year or two later, and just continue to hold it for 4 or 5 years, you still end up making double-digit rates of return. Value investing is about investing in a company when its intrinsic value is below its current market value. That is the secret to investing. And a lot of these banks have been really hit hard after the recession of 08 and 09. So I like all these. Let's go back into the portfolio and let's look at the current valuation. The most undervalued of this group would be the Bank of the Ozarks. Okay, the highest earnings yield among this group would be Bank of the Ozarks. Okay, the highest yielding stock of this group would be AROW Financial. Bank of the Ozarks is decent at 3.5%. So again, whatever your starting need is, and you got to look at how much income you need and how fast it can grow, and the fact that it is going to grow. So these are 6 regional banks that are also dividend champions that have increased their dividend every year for 25 years consistently. And if you're looking for income, and if you're looking to live off that income, this is exactly the kind of company you should be looking at. Investing comes in all different styles and sizes. There is no such thing as one size fits all. I've said that so many times. So if you're looking as an income investor, you stand to make a decent amount of money choosing any one of these banks, or all of them for that matter. That's up to you. But I do caution you to do your own research and due diligence. And for goodness sakes, if you don't own fast graphs, if you haven't taken advantage of the opportunity, if you own stocks and you don't own fast graphs, you're putting yourself at a disadvantage. And the thing is, learn to trust your own judgment and learn to trust the fundamentals, and quit focusing and obsessing over stock price volatility. That's a nature of the beast. It's always going to be there. And sometimes the volatility is justified, sometimes it's not. But like I said this before, and I get comments, Warren Buffett said he'd be a bum in the street with a tin cup begging for nickels and dimes if the market was always efficient. The market is not always pricing stocks correctly. Fundamentals matter more than short-term price. And all investing implies long-term ownership. And all investing implies buying at value. Otherwise, you're speculating. Thanks for watching, and tune in for our next video. Thank you.